All right, welcome back, everybody. Hope everyone enjoyed our last session with Mark Massey at SMA. Really great information, and we're going to keep again the theme of retirement plans rolling as we talk about challenges and strategies, especially in today's current environment with Stacy McMahon from Pacific Life. Just as a reminder, the session's being recorded, and everything will be available at the conclusion of our program on our website under NAIFA's Business Performance Center. We encourage interactivity, so I hope that everyone can use the chat or Q&A feature at the bottom to post questions throughout. I know we've budgeted some time at the end to make sure that we can get those addressed. And again, everyone will be in listen-only mode. And I do encourage you, please, as another reminder, sending out a survey, please offer some feedback. It helps us get better, and we want to continue to bring relevant programming to you as we continue throughout the year. So before I turn it over to Stacy, just a quick introduction. Stacy McMahon is a senior consultant in Pacific Life's Advanced Designs Unit, a highly recognized team of advanced market experts in the life insurance industry. She coordinates the ADU's quarterly National Strategic Alliance series webinars, as well as the advanced planning strategies for Pacific Life's long-term care products and chronic illness rider. Stacy focuses on business planning, executive compensation, retirement planning, and estate planning, with an emphasis on life insurance taxation and qualified plans. In addition, Stacy prepares presentations and speaks to life insurance producer groups, advisors, and financial organizations all across the country. She is an Ohio State graduate, probably a little down since her team took an early exit this year in the NCAA tournament, as they had high aspirations as a 2 seed. And she has her law degree from Pepperdine University, which I imagine is a great place to study and look out over the ocean. So I'm going to turn it over to Stacy to get started. Again, keep those questions coming. We'll address them at the end. And Stacy, thanks for spending some time with us today. We look forward to your presentation.
Thank you so much, Brian. Thank you, NAIFA and FSP, for getting this whole conference together, this Impact Week. I've been able to chat with everybody and see also a couple of the other presenters' presentations. So it's been really a joy. Wonderful. Today, as you can see here, we're talking about retirement planning. Gosh, if we haven't seen some challenging times recently, we're looking at your clients, and they're probably wondering, hey, am I on track for retirement? They're coming to you probably in droves a little bit now that we're hopefully seeing the light at the end of the tunnel with COVID. We're going to talk about how that past legislation and upcoming legislation, and how that might affect your clients' retirement planning overall. So we'll talk about individuals as well as business owner clients, and we're going to look at some strategies to help your clients address what's going on in their particular planning arena there. And we'll wrap it up with a case study to kind of just illustrate how we can help 3 very different clients. Of course, we have to fit the client's need, right? We can't just go with our favorite bread and butter strategy for each and every client. And hopefully we'll have time for some questions. We have a lot of slides here, 31 slides, as you can see. So I'm just going to move on through. All right. Just to give some perspective, let's start with year 2019, right? 2 years ago, it seems like that was just la la land back in 2019. We were hearing experts talk about, the economy was going pretty much gangbusters, and we were talking about, how they can draw down their accounts. Then the Secure Act had a few surprising provisions in there, but we thought, okay, we'll have 2020 to figure it all out. It's a pretty big bill as part of a big omnibus bill. So we want to make sure we understood what was going on with Secure Act and how we could help our clients through that. Then COVID came along, and of course, that just threw everything into a tizzy. Then we stopped hearing about economic security. We started seeing things about, hey, make sure your powers of attorney are all set up. Business owners might be looking to have an unexpected retirement, or maybe they're going to have to be working even longer, not just business owner clients, but individuals as well. And then, of course, due to COVID, it was much harder to actually reach out to your clients, right? Everything had to switch to Zoom or GoTo or some kind of virtual experience. And that was just kind of odd. It was very different, and everybody figured it out, obviously. NAIFA and FSP are doing a great job here. And we had to figure it out at Pac Life. So to just make sure we were available to you all and so you could help your clients. But now we're seeing a bit of a backlog. I think everybody's coming around and figuring out it's time to move ahead with their planning. Something that is always been on my mind, I keep hearing about, is Social Security really secure? That's always just been a really strong support for many Americans, retirement planning, and it still is. But something happened during 2020, as we all know, and we'll cover a lot more about Social Security in more detail. But just taking a look at everything else, how's everything else impacting us? As you might have been aware, we had some political things happening last year. We have CARES Act, and there's some leftovers from that as well. We are looking at a lot of regulations. I'm going to talk in detail about the Department of Labor rule in a little bit, but the SEC's Reg BI, the best interest standard, came into force. NAIC started seeing a lot of states adopt their regulations. New York has its own Reg 147, and we're seeing a lot of states follow suit and start coming up with their own fiduciary rules. And of course, the economy. I mean, we had record unemployment, so a lot of your clients were possibly impacted by that. And so now we're coming into 2021, and I want to look at 5 areas that were really going to impact your clients' retirement planning and how that goes. So you can see number 1 here, Secure Act. We'll talk a little bit about some of the impact of that. And Secure Act 2.0 is potentially coming down the road. There's a lot of bipartisan support for that. And COVID and the corresponding CARES Act. We'll talk about some of those impacts. Social Security, as I mentioned, how secure is it really? And something that really could have slipped by a lot of people is the new RMD tables, the required minimum distribution tables. We'll talk about that as well. And then laws and regulations on the horizon. We just had the big stimulus bill come through recently, and a couple weeks ago, we were at our tax lady's appointment when it came through, I think on the 10th or the 11th, and she was just in a tizzy. She had to start canceling all of her appointments for people that had unemployment because they made that change with the excluding a portion of the unemployment income for folks. So she was very stressed out that day. But I hope we're able to at least talk about these in an opportunity theme today and give you some ideas. Now, if anyone has a crystal ball that's working, please let me know. I stopped filling out those March Madness brackets a long time ago because, especially with any money down on them, because I just don't have a vision for that. And certainly we have some clue as to what may happen on the horizon, but nobody really knows for sure what will actually come into play and through Congress, what will actually get passed, right? So we'll take a look at just covering the consumer part of the Secure Act. The RMDs, as we know, moved from, you have to start taking those at age 72 now instead of age 70 and a half. The inherited IRAs changed drastically. There's only a few people that can still do that stretch IRA over their lifetime. That's spouses and minor children, but then there's a little catch there with minor children. But adult beneficiaries, adult children, grandchildren, there's no stretch IRA anymore. Contributions can be made now past age 70, which is great. All that took place immediately. And there was, on the business side of things, on the plan sponsor side of things, there were some delays. But let's first look at the consumer side. And starting with that stretch IRA that I mentioned, of course, we're looking at, higher taxes if they have to take out that IRA, if you're IRA beneficiaries have to take out the funds, and it's no longer RMDs, right? It's just within 10 years they have to take those funds out. That's a big difference from a lifetime, right? Now, I think maybe for a smaller IRA, a lot of people are just going to, take it out lump sum in, the first or second year. So not a big deal. But for those people that were planning on stretching out a pretty sizable IRA, that's going to be a little bit of a wake-up call there. We also have higher AGI and taxable income effects. The 199A, Medicare Part B. We'll talk about this in more detail. But just, and then the bigger thing I think is now we don't have any tax deferral, right? Over that time, you have to take that out. And if you're not spending it immediately, of course, it's going to be taxed on any growth there. So on the planner side, just to take a look at some ideas on steps you can take with your clients. First of all, just figure out if this is even applicable. If the IRA owner has used up all their IRA and there's nothing to leave to the adult children, then there's no issue there with the stretch. Reviewing trust language. This is a big deal because how those trusts were set up, the IRA basically was able to be stretched through the trust. And now, after the Secure Act, what happened was, I'm hoping it was kind of an unintended consequence that basically the people are going to have to wait for 10 years. If they don't change their trust, they're going to have to wait for 10 years, and then it's going to be a lump sum at the end of the 10th year. So they won't have any access to it until the 10th year, which is not what people were expecting. So definitely checking into those trusts, conduit trusts, et cetera, looking at the beneficiary language, making sure that is done ASAP. Talk to your estate planning attorney or your client's estate planning attorney for that type of work, of course. Taxes on estates and beneficiaries, now that stretch has been eliminated, that's going to be even more important to take a look at that. Some planning ideas, of course, Roth conversions. They may want to look at that in a lower income tax year. If they're hitting like a bad sales year or something, that might be a good time to do a Roth conversion, or at least part of one. Life insurance as an asset is going to be a great idea, and we'll talk in more detail about that, as well as just anyone who's charitably inclined. We always like to at least propose charitable trust idea. All right. On the business side, again, I said it takes longer for businesses to implement these things. Employers weren't super excited, I don't think, but it was a good thing for the participants that now these lifetime income projections have to be provided by the employers. So basically, we're taking here's your pot of money in your 401k or your 401(b), Mr. or Ms. participant, and here's what it could look like as an income stream, kind of like Social Security, but it's basically just taking their private 401k and showing them what it could look like for them. And there are temporary regs that are supposed to come out later this year, so we'll take a look at that. Another big thing was, this doesn't impact Pacific Life specifically, but I just want to make sure you're aware that multiple employer plans, MEPs, and pooled employer plans, PEPs, got a little bit of a reprieve. We didn't see a whole lot of adoption with those plans because the rules were pretty onerous. They had to have some correlation between the businesses who were pooled together. But now with the Secure Act, it's going to make it much more accessible to small businesses. So check in on more details on that if you're curious on that. And those didn't gain a whole lot of traction because of COVID, but now I think we're seeing a lot more activity. And the permanent part-time coverage folks working 20 plus hours, but they're permanent, they're not seasonal employees. Now they can also contribute to a 401k, so that's great. And of course, our RMDs, we'll talk about that in more detail. All right, with COVID, we are seeing, we saw the CARES Act with the stimulus, of course. Businesses are still catching up from trying to make sure they're taking care of all their deferring payroll tax or the payroll protection and all those details. We also had a law, not sure if you're aware, that went into effect late 2020, the Taxpayer Certainty and Disaster Relief Act, Disaster Tax Relief Act. Pretty complicated name. It did extend a few things. It took some things away from the CARES Act. One important thing is that unlimited charitable deduction that you can take this year. For those who are not itemizing, they can, before this Disaster Tax Recovery Act, it was singles and couples could take a $300 deduction on top of their standard deduction. But now they parsed it out so that couples can deduct twice that amount, so $600 on top of their standard deduction. So that's helpful for those charitably inclined folks. And COBRA extensions, RMDs suspension, remember that was for 2020, that did not get extended. So RMDs should be taken out in 2021. I'm sure you're all aware of that. And they also snuck in the very end of 2020, the 7702 changes that affect life insurance in our illustrations. So we're furiously working on all of that. And stay tuned for Pacific Life, providing updates on that as well. I keep an eye on my time. My time is not showing up here. Okay. All right. We are doing good here. With Social Security, there was a trustees report that comes out, and they have declared in no uncertain terms that they're definitely in the deficit mode. There's more going out from Social Security than is coming in. I think that started maybe in 2020, but it's definitely happening now. And the expected trust reserves that everything's if you're paying out more than you're taking in, you're digging into your trust reserves, right? So the expectation from that trustees report was that trust reserve will be depleted in 2035. So a decade, and maybe 14 years from now, it's coming up. And we're also seeing, by the way, this did not include, does not take into consideration any COVID numbers. So we're looking at, payments. They're not going to stop paying Social Security payments. They're not going to just keep paying them in full and making this deficit balloon even bigger. Hopefully that's not going to happen. But the most likely thing seems to be that they will just prorate those benefits, right? So they'll be closer to 78 to 85% of what is currently being paid out. Now that's a pretty serious change, and we'll see what they may have to do to rectify that. With the Penn Morton budget model, that's where these numbers are from. Just note there that they were looking at it was a U-shaped pandemic, so it kind of dropped down, goes down, stays flat for a while before it recovers back. Economy-wise here, Social Security will see possibly more deaths, so maybe some death benefits paid out, but those income payments will go away. So that actually, hate to say it, but it actually helps Social Security a little bit. But yet we have all the record unemployment and people not paying into payroll tax. So that's on the con side. But all this together is really going to potentially speed up. We can see that number, the 2032 number. Folks, that's in 11 years. So we are going to have to see how we can maybe reset clients' expectations for those that are going to be retiring much later, into 2030, 2040s. All right, with RMDs, I said I would talk about this in more detail. We have those new life expectancy tables, and the regs came out late last year. That basically extends the life expectancy to an additional 2 years. So those RMDs will now become smaller, right? Because we have longer to take out those IRA funds. And they'll be smaller. This doesn't start, just note this doesn't start until 2022. So if your clients are taking the smaller RMDs this year, it's going to cause a really big problem. It's going to be a 50% penalty. So make sure they're not taking those out until 2022. But just think about what this means for those, maybe people don't want to take the smaller RMDs. Maybe they want to take larger RMDs, which is their prerogative. But if they don't, and they're taking those smaller RMDs, these sizable IRAs and 401k balances could really start getting even bigger. And it means more taxes on those, either them or their beneficiaries. So just to give show some numbers with this so we can see what's going on. Let's look at the before numbers. If there had been no Secure Act or CARES Act, here we have a person retired last year, age 70. They had $1 million IRA, and they started taking out their RMDs. And in 10 years, we're just assuming zero interest on both of these scenarios because it's just simpler that way. But not realistic, but let's just assume 0%. They'll still have $642,000 left in their IRA, but they've taken a third of it, right, in 10 years. But now we have Secure Act, we have CARES Act, so they don't have to start taking out their RMDs until age 72, which is good. We have these lower RMD figures, and starting in 2022. So now they should have about 711,000 in this scenario. So that's great, great for them. Maybe that's good for some folks, but for the folks who are worried about income taxes for them, or maybe they're adult children beneficiaries, we just want to make sure they're aware that that's going to be an even higher tax hit for those folks, right? So just talk to your clients and see if they're interested in, if they really want to take the smaller RMDs, or they want to use those RMDs for themselves or for other things. All right, on the horizon, as I said, we're not trying to predict the future here, but we want to make sure people are aware of Secure Act 2.0. That's that fairly bipartisan piece of legislation. We'll see what happens with that. I haven't heard anything really recently about it, but there's employer credits for contributing to 401ks and automatically signing people up for that. With RMDs, they're looking at changing that to age 75. If you can imagine, and maybe even looking at a more liberal catch-up amount for 401ks at age 60 to the tune of $10,000 a year or more. So more and more money maybe going into these plans if that gets passed. With the Biden administration, there's talk, and then there's what's going to really happen, right? So we're going to see an income tax rate go from 37 back to the 39.6%, possibly a state tax exemption amounts and gift tax, talk of moving that back down to 5 million or maybe 3.5 million. I've even heard a possible 1 million exemption amount, or at least for the gift tax side. They're even talking about getting rid of the carryover basis, right? Or implementing the carryover basis and getting rid of the step-up basis. So regulatory things. I do want to mention, as we mentioned, NAIFA before, and other states having their fiduciary rules coming into place. The Department of Labor rule that the Trump administration announced last year, again late last year, that did become effective. The Biden administration let it roll, and they plan to build on it, is what we've heard. There's a little bit of a concern there, just so you're aware. We'll keep our eye on it. But there's a 5-part test in there that was broadened pretty expansively, and there's just a concern that a lot of folks, a lot of individuals, entities, advisors who aren't expecting to become fiduciaries may become fiduciaries under this rule. And we're just looking at, from our concept side, IRA related transactions as well as qualified plans. Those could require some fiduciary compliance. So which prohibited transaction exemption they want to use, that's really up to them and their advisors. But I just want to make sure you're aware of that could be considered fiduciary advice. So we'll have to see, we'll have to look out for that. I think we'll see some serious SEC enforcement of that Reg BI, and Social Security, as we talked about, is pretty much changing. All right, so just all this means a reason to meet your clients. I just want to quickly cover this slide in light of our time here. Roth IRA planning, some conversion planning, looking at life insurance, that DIY, do-it-yourself defined benefit plan. That's basically look at annuities. Those could be a SPIA, could be a deferred annuity. IRAs, I think I mentioned CRTs. If you have a charitably inclined client, that's always a great idea to look at, maybe even a QCD as well, qualified charitable distribution from the IRA. So great opportunities for your clients. And here's some other reasons. We always think, maybe it was a financial hardship for your clients, or maybe they're doing okay, but they they want to do an early retirement. But just be aware, they might not be aware of all the rules of, taking out Social Security before that full retirement age. Maybe they don't realize, they're too young for Medicare. So just covering all of these topics is a great reason to talk with your clients. We just keep in mind all those, the RMD changes, the stretch IRA changes, those trusts that I mentioned, doing some Roth planning for the right type of client. And business owners, they've been affected somehow. Hopefully good, hopefully not in a negative way, but there have been some definite changes there for those folks. With looking, where to put the assets, do we want to put them in an after-tax account or a pre-tax account? Really depends on the client, right? Do they want to delay their RMDs? There's nothing saying they have to take them out, before that. You can start taking them out earlier, I suppose, but do you want to delay it as late as possible? A lot of folks are not fully retiring. They're going to part-time work, and you can still contribute to IRAs after age 70 now. So some ideas there, again, the trust issue, make sure those are appropriately worded, and look at different tax strategies and some products. So a great place to start here is the stretch IRA conversation. As I said, this is eliminated for the most part, except for spouses and for minor children. So I'm not going to go to the chart in detail in light of our time here, but just be aware that a lot of people think grandchildren, they can do the stretch. That is not an option for grandchildren if they're the beneficiaries. But adult children, making sure that that beneficiary is actually designated, that gives them the 10-year distribution time. If it's not designated, they can shorten it even to 5 years. So we don't want that to happen for your folks. And taxes, let's just do a slide just on taxes here. Of course, someone brings in $1,000, taxed on 20% of that, they're going to net 800. So of course, less money coming in. If there's more income, they might hit a higher tax bracket. And one thing I keep hearing, the Biden administration, they're not planning on raising taxes on those making less than $400,000. Well, there's ways around that, right? The Social Security tax that could hurt even middle income folks by a 40% increase. Medicare Part B, there's been a huge increase. This is kind of like a version of means testing, right? If you make too much money, your premiums are going to go up quite a bit. Those net investment income tax and Medicare payroll tax, that hits people at those non-indexed threshold amounts, right? 200 for singles, 250 for married filing jointly. So more and more people are going to be coming into those additional taxes. Of course, the QBI reduction, if you make too much money, and especially if you're in a specified service business, that can get phased out pretty quickly as well. So just making sure that people are aware of all the rules, especially those RMD tables, and that they do have to take an RMD this year. That suspension was only for 2020. And Roth IRA planning, just don't want to go into great detail on this in light of time. I want to get to our case study, but we can see this really depends on what you think is going to happen with taxes. And then the timing strategies there. If they have a temporary low tax, as I mentioned before, if there's like a bad sales year, that might be a great time to do a Roth conversion. If the market goes down like it did last March, that might have been a great time. So who knows what will happen in the markets this year, but that makes sense, right? And then converting just up to, but not going into the next tax bracket. That's another great strategy. There's quite a lot of play between the two, 22 to 24%, and a pretty big one from 24 to 32% bracket. So, so you have some wiggle room in there for those clients looking to do that. The old strategy here, I'm going to talk about this in detail in the next slide or two here. And it's just basically, if I have an IRA owner, they can use those distributions. They could take them or leave them. They don't need them for living expenses or their travel plans. Hey, look at leaving a death benefit to the adult beneficiaries. If it was a great idea in 2015, it's an even better idea now, I think. because we have that stretch IRA going away for those adult beneficiaries. And we want to take a look at a life insurance policy. So the IRA idea is the IRA owner would be the owner and the insured of the policy. They can either use that death benefit to help the adult beneficiaries pay that tax hit, and that death benefit, of course, should be tax-free, assuming the policy is set up properly. Or if the donor buys the policy and it's a cash value life insurance policy, hey, they can access that cash value through loans and withdrawals as well. So it's pretty flexible. If the IRA owner is going to have an estate tax problem, just have that policy owned inside an ILET to provide that estate tax liquidity. So great idea for those folks who have an IRA that's basically a surplus asset. With our payout strategies, I'm going to talk about these in great detail with our case study. But just be aware that our mortality, we've estimated it's 1 year worse now than it was due to COVID, but yet longevity, for the most part, has gone much longer. So we have market volatility. What do you do with sequence of returns? You want to make sure they're not pulling out assets that are going to be, especially if they're going to be taxed when the markets are down. So try to look at some strategies that will avoid that. All right, getting to our case study here. I think this is really helpful because at first glance, these ladies are all age 65. They all are looking to get about $30,000 a year in Social Security. They all have $1 million IRA, or I'm sorry, 401k as well, and they have adult children. But those adult kids are doing fine. They don't need help from mom. So, but these ladies would like to leave a legacy to those children if it's possible. But we can see there are differences here. Abigail is risk adverse. She wants to keep it really simple, and she wants a pretty solid $80,000. She's told you, and she's a little bit scared of stocks. So that's our Abigail, and we see this is A, B, and C, and we probably have the full alphabet, or maybe not quite that many different drawdown strategies, but you're definitely gonna have that many different clients, right? All their different set facts and circumstances. With Beth, she's a risk taker. She's disciplined. She's looking to hire you as her planner, and she's saying, hey, here are my assets. Just let me know what I'm going to be able to take out of Social Security and what I'm going to be able to take out of my assets, and let's go with that. Let's plan for inflation, but she's not as concerned. Now Camila, she's also pretty disciplined, but she's saying, hey, look, I want you to tell me how much I can take out of my 401k here and how much I'm going to get from Social Security, but I really don't want to go back to work, and I am really scared of the markets. Should I be in the market? She's asking you. Let's take another look at our ladies here. We have to fit it to the client, right? We can't say, I just want to pick my favorite strategy and apply it to everybody. Of course, that's not what we're doing. For Abigail, we're just going to use that standard flooring strategy where we try to lock in as many types of guaranteed income as possible. And let's say maybe take an 80,000 SPIA, a single premium immediate annuity for her. And the rest of that 200,000 we have left over, we can put that in the market, right? And that can be either be there for long term, she has long longevity, or maybe it'll leave a legacy for her kids, which will be great. For Beth, we're looking at more that rule of thumb, a specific 4.5%, maybe even a smaller percentage, just to be really conservative. What do we want to do? Maybe put 60 in equities, 40% bonds, and make sure we're adjusting that for inflation. And that's going to get Beth to about 75,000 per year. So she's going to be happy with that. Now, Camila, we're looking at the bucket approach, right? She's really concerned about that long term. So we know there's 3 buckets. We'll have the short term, midterm, long term, much more liquid, going all the way to much more aggressive and growth phases for her years. So she'll have the short term for her slowing down years, but she's still going, and phasing it out to the much more slowing down years. But she'll have that. She'll be much more comfortable being in the market with that long term investment because it's long-term, right? She doesn't have to worry about what's going to happen just in the next 3 to 5 years. She's looking out at 20 years for those market investments. So the idea here, of course, which you all are great at doing, is customizing it for the specific client. Anytime we have a wealthier person, of course, all rules are off, right? We're not looking at any specific drawdown strategy. Well, you have to have 80% of your pre-retirement income coming in retirement. All rules kind of go out the window here. So for Pat, she has 15 million in her business, 4 million in her real estate, which is growing, which is great, and 3 million in pension, IRA, and Roth assets. So this is our typical affluent wealthy person. She's going to start taking her consulting income and deferred comp first, right? Because her business will get deductions for that, presumably. Then next, she'll take her IRA distributions and her pension payments, and that's going to lower her taxable estate. And she's saying, I'm okay paying 37%. Hopefully it stays 37% at the top rate there, rather than 40% at the estate level. She's chair-being clients, so she's looking to do at least a partial QCD there, turn some of that into charity. And she's definitely looking at the Roth IRAs. If she's got kids, she's doing well. We're assuming her kids are doing well as well. That's what happens when we get an inherited IRA over to an adult child. They're usually in their top earning years, right? So we want to try to lessen that 10-year stretch hit, or that taxation that's going to come out in 10 years instead of over their lifetime. And then for her business and real estate assets, let's look at maybe not gifting those, but getting those down at death. That keeps that stepped up tax basis. And then also, the potential 199A deduction, the C Corp tax, we're looking at maybe going up from 21 to 28% tax. So all things to consider there for your wealthier clients. And just a really brief comment that, estate planning is really going to have to be part of a lot of your clients' retirement planning. So just don't discount that. Make sure all the bases are covered there. And again, we don't know exactly what's going to happen with the TICJA sunsets. One consideration to think of is with future, and there's a Jobs Infrastructure Act that's the Biden administration is looking at right now. Start looking at maybe some of the things on the other side of the table, right? Hey, a bunch of these things are sunsetting anyway, so the Republicans might want to say they'll have that as a little bit of bait, right? We'll have that's going to sunset anyway, so we'll give you that. We won't change the income tax rates now because those are going to sunset. Same thing with the estate taxes and gift tax exemptions. Keep an eye on Secure Act 2.0, and we'll be monitoring all these things carefully, and want to make sure that we're always looking for great strategies to help you and your clients, and then how to pivot if X, Y, or Z happens. So stay tuned for that. We do have a whole team of us at Pacific Life in the Advanced Designs Unit. There's 6 of us. And there's our general number, and there's my email address. So feel free to contact me and reach out if you have any questions after this webinar. Thanks, and back to you, Brian. Do we have any questions?
Yeah, no, Stacy, a great insight. Thank you for all of that. We do have a few questions. Which clients may be an ideal client who may want to make adjustments due to the elimination of the stretch IRA?
Okay, well, good question. It depends on the IRA owner, I think, if you're talking about the IRA owner or if you're talking about the beneficiary. If you're talking about the IRA owner, a great person is someone who doesn't need those assets, right? They're doing okay. We don't want this to be, don't want to be pulling out money for doing a Roth conversion, paying higher taxes if they're gonna need those funds for retirement. So someone who's happy to deplete it and get it down to the next generation. I would say that for the IRA owner. And for the beneficiary, there's not much you can do about it. They are who they are, but if they're in a lower tax bracket, then it's obviously gonna not hit them as hard when they have to take out those distributions over 10 years.
And You may have you touched upon this a little earlier when you referenced Social Security, but on the topic of insecurity of Social Security, essentially meaning the depletion of the trust reserves by 2035 or even 2032, how might the current administration try to cure this issue?
What I've heard with the Social Security is the Biden administration is considering, again, that, not taxing those who make under 400,000. So as we know, right now, Social Security is only taxed on the taxable wage base, so 142,000, I think, a year approximately. But the talk is that they'll do a donut. So starting at 400,000 and up, then that Social Security will kick in. And I even saw one article saying, not the 6.2 might be doubled, maybe 12.4. So we'll see what happens there. But I think that's one way. And again, of course, may be some means testing. Right now, anyone making over 44,000 a year is going to have 85% of their Social Security benefits taxed. So maybe they'll up that percentage, to 100%. Maybe they'll need to. I don't know what they'll do with that threshold income amount. But we're looking at curbing those benefits back to, as I said, 78 to 85%. I don't know if we'll. I think that donut is a really feasible strategy that they're going to try to. That's how they're going to try to help Social Security get more funds in there, right?
Yeah, interesting. Yes, and with any change in administration, whether it's Democratic or Republican, there's always new, unique challenges that our industry is faced with. So, some great insight into that. Stacy, again, appreciate your time today. I think everyone benefited from all the information that you shared during the session. NAIFA appreciates its collaboration, not just with Pacific Life, but with FSP. And so everyone else knows that's participating today. Stacy shared some information today. We had Kathleen Bilderback, Ron Lee from Mutual of Omaha, Andrew Wren from Emeritus. We are going to have continued programming throughout the year that's advanced practice focus in collaboration with the Society at FSP. We value our partnership. And so for everyone, be on the lookout for more programs relating to more advanced practice topics as the year progresses. We are going to take a quick break before we come back to our final session of Impact Week with Brad Swinehart of White Glove, who's going to talk to us about showcasing authenticity through captive marketing. And if you guys aren't familiar with White Glove, fantastic group, really kind of changing the game within the service in the financial services space regarding marketing. So anxious to hear what Brad has to say and learn a little bit more about White Glove as well. So tune in, top of the hour. So we'll see you in about 15 minutes. Thank you very much.